Welcome back to Drowsy Tales Daily. Tonight I have 33 incredible stories from Reddit about banking frauds and financial institution deceptions where trusted bank tellers, loan officers, investment advisors, and financial executives deliberately betrayed customer trust through account manipulation, loan fraud, investment scams, and fee schemes that turned essential financial services into devastating monetary exploitation and violated banking industry standards. Our first story takes us to First National Bank in downtown Minneapolis, where teller Samantha had been serving customers for 7 years. She was beloved by regular customers and respected by management for her attention to detail and friendly service. Samantha seemed genuinely caring about helping customers with their banking needs. "Samantha always goes the extra mile to help me understand my account," praised longtime customer Marcus during a customer satisfaction survey. Her knowledge and personal attention make banking feel comfortable and trustworthy. But customers started noticing unauthorized transactions and account fees that Samantha claimed were normal banking charges they hadn't understood before. "There's a $50 service fee on my account that was never there before," explained confused customer Elena to the branch manager. "Samantha says it's always been part of my account agreement, but I never agreed to any fees like this." When Elena requested her original account documentation, Samantha provided papers that seemed different from what she remembered signing when opening her account. Investigation revealed Samantha had been systematically adding unauthorized fees while creating false documentation that made illegal charges appear legitimate. She'd been accessing customer accounts to add monthly service fees, overdraft charges for transactions that shouldn't have triggered fees, and maintenance costs that weren't part of original account agreements. The scheme particularly harmed elderly customers on fixed incomes who trusted Samantha's explanations but faced mounting fees that consumed their limited banking resources. Samantha had been meeting branch profit targets while customers faced financial strain from unauthorized charges that violated their account terms. When banking regulators investigated her teller activities, they found evidence Samantha had stolen over $400,000 through unauthorized fees affecting nearly 800 customers who trusted her banking expertise and account management. Our second story comes from Metro Credit Union, where loan officer Blake had been helping members secure personal and home loans for 9 years. He consistently achieved high approval rates while helping families access credit for important purchases and financial needs. Blake seemed knowledgeable about lending programs and genuinely committed to helping members achieve their financial goals. "Blake helped us get approved for our home mortgage when other banks turned us down," announced grateful member Victoria during a credit union testimonial. "His expertise made homeownership possible when we thought our credit wasn't good enough." But borrowers started discovering their loan terms were significantly different from what Blake had promised during the application process, with higher interest rates and additional fees they never agreed to accept. "He told us our mortgage rate would be 4.5% with no prepayment penalties," explained shocked homeowner Carlos to the credit union board. "But our actual loan is 6.2% with huge penalties if we try to refinance." When Carlos confronted Blake about the rate discrepancy, Blake blamed market changes and underwriting requirements beyond his control. "Interest rates fluctuate during processing, and final terms depend on underwriting approval," Blake explained dismissively. "You should have read your closing documents more carefully before signing." But investigation revealed Blake had been engaging in classic loan fraud by promising attractive terms to win applications, then switching borrowers to expensive loans with higher rates and penalties at closing when customers felt pressured to complete their purchases. Blake had been collecting higher commission fees from expensive loans while borrowers discovered they couldn't afford payments or refinance to better terms they had originally been promised. The scheme particularly harmed first-time homebuyers who trusted Blake's expertise, but ended up with predatory loans that consumed their family budgets and threatened their homeownership dreams. Blake had been meeting lending volume targets while families faced financial hardship from mortgages they couldn't afford based on the terms they actually received. When federal investigators examined his lending practices, they found evidence Blake had manipulated loan terms for over 300 families, while collecting nearly $200,000 in excess commission fees from predatory loans that borrowers never agreed to accept. Our third story involves City Savings Bank, where branch manager Chloe had been overseeing daily operations for 8 years. She consistently maintained high customer satisfaction while managing teller operations and account services for hundreds of banking customers. Chloe seemed professional and experienced in banking operations and customer service management. Chloe runs the most efficient branch in our region, praised Regional Director Nathan during a management meeting. Her customer service expertise ensures excellent banking experiences while maintaining operational efficiency for our business objectives. But customers started questioning why their account balances didn't match their transaction records, with missing deposits and unexplained withdrawals that Chloe claimed were processing errors or system glitches. My paycheck deposit is missing, and Chloe says the computer system is having problems, explained concerned customer Fiona to the corporate customer service department. But this is the third time my deposits have disappeared, and I need my money for rent and bills. When Fiona demanded detailed transaction records, Chloe provided statements that seemed inconsistent with the actual deposits and withdrawals that should have been reflected in her account balance. Investigation revealed Chloe had been systematically stealing customer deposits while creating false transaction records that concealed her theft from bank oversight and customer detection. She'd been intercepting cash and check deposits, transferring funds from customer accounts to accounts she controlled, and manipulating computer records to hide missing money that customers expected to be available for their financial needs. The scheme particularly harmed working families who depended on timely access to their paychecks but discovered their deposits had been stolen when they needed money for essential expenses like housing and utilities. Chloe had been enriching herself while customers faced financial emergencies from missing deposits that should have been safely held in their banking accounts. When bank auditors investigated her branch management, they found evidence Chloe had stolen over $2 million from customer accounts while creating false records that concealed systematic theft affecting nearly 1,200 customers who trusted their bank to protect their money. Our fourth story takes us to Regional Bank, where investment advisor Derek had been managing customer portfolios for 11 years. He consistently helped clients build wealth while providing guidance on investment strategies and retirement planning. Derek seemed knowledgeable about financial markets and genuinely committed to helping customers achieve their long-term financial goals. Derek's investment advice has helped me build a solid retirement portfolio, praised satisfied client Grace during an investment seminar. His market expertise and conservative approach have protected my savings while generating steady returns for my future security. But clients started discovering their investment returns were significantly lower than what Derek had projected, with some accounts showing losses rather than the promised gains. My retirement account has lost 20% of its value when Derek promised stable growth, explained concerned client Hugo to the Securities Commission. He said conservative investments would protect my principal, but I'm losing money instead of building wealth for retirement. When Hugo requested detailed account statements, Derek provided reports that seemed inconsistent with actual market performance and investment results that should have been reflected in portfolio values. Investigation revealed Derek had been diverting client funds to high-risk investments while reporting false returns that concealed losses from speculation that violated conservative investment strategies he had promised to follow. He'd been using client money for unauthorized trading that generated commissions for him, but created losses for customers who expected safe investments, gambling with retirement funds on risky ventures while reporting fictional gains to hide investment failures. The scheme particularly harmed elderly clients who had trusted Derek with their life savings, expecting conservative management, but faced retirement insecurity from investment losses they never agreed to risk. Derek had been earning trading commissions while clients faced financial ruin from unauthorized speculation that destroyed retirement security they had spent decades building. When securities authorities investigated his investment management, they found evidence Derek had lost over $8 million of client funds through unauthorized trading while reporting false returns that concealed investment disasters affecting nearly 400 clients who trusted his conservative investment expertise. Our fifth story involves First Citizens Bank, where credit card manager Isabella had been overseeing card operations for 6 years. She consistently managed credit card programs while helping customers access credit and manage their card accounts effectively. Isabella seemed professional and knowledgeable about credit card operations and customer service procedures. Isabella's credit card management provides excellent customer service while maintaining efficient account operations, announced Operations Director Jack during a departmental review. Her expertise in credit management helps customers access credit while protecting the bank's interests in card portfolio performance. But credit card customers started discovering unauthorized charges and interest rate changes that Isabella claimed were part of their original card agreements or standard industry practices. My interest rate doubled overnight, and Isabella says it was always a variable rate, explained frustrated cardholder Kai to the Consumer Protection Agency. But my original agreement showed a fixed rate, and now my payments have become unaffordable for my budget. When Kai requested his original credit card application, Isabella provided documentation that seemed different from what he remembered signing when opening his account. Investigation revealed Isabella had been systematically manipulating credit card terms while creating false documentation that made unauthorized changes appear legitimate under original account agreements. She'd been increasing interest rates without proper notification, adding fees that weren't disclosed in original terms, and modifying credit limits in ways that triggered penalty rates and charges that customers never agreed to accept. The scheme particularly harmed customers with good payment histories who trusted Isabella's explanations but faced mounting credit card debt from rate increases and fees that violated their original card agreements. Isabella had been meeting bank profitability targets while customers faced financial strain from credit card costs that exceeded what they had agreed to pay when opening their accounts. When banking regulators investigated her credit card management, they found evidence Isabella had illegally modified over 2,000 credit card accounts while generating unauthorized fees and interest charges exceeding $3 million from customers who never consented to the changed terms. Our sixth story comes from Community Bank, where mortgage specialist Lance had been helping families secure home loans for 12 years. He consistently guided borrowers through the mortgage process while ensuring successful loan closings for homebuyers and refinancing customers. Lance seemed experienced and genuinely committed to helping families achieve homeownership and access favorable mortgage terms. Lance made our mortgage process smooth and helped us get better terms than we expected, praised homeowner Maya during a customer testimonial. His knowledge of mortgage programs helped us save money while making homeownership affordable for our family budget. But borrowers started discovering their mortgage payments included charges and insurance requirements that Lance had never mentioned during the loan application and approval process. Our mortgage payment is $300 higher than Lance calculated, explained shocked homeowner Noah to his real estate attorney. He never mentioned flood insurance requirements or mortgage insurance costs that make our housing payment unaffordable for our income. When Noah questioned Lance about the unexpected mortgage costs, Lance claimed all fees were disclosed in closing documents and were standard requirements for mortgage loans in their area. Mortgage costs can vary based on final underwriting and insurance requirements, Lance explained defensively. All charges were properly disclosed according to federal lending regulations. But investigation revealed Lance had been deliberately underestimating mortgage costs while concealing insurance requirements and fees that would make loans unaffordable for borrowers who trusted his payment calculations. He'd been hiding flood insurance requirements, understating property tax and mortgage insurance costs, and failing to disclose fees that significantly increased monthly payments beyond what families could afford. The scheme particularly harmed young families who had budgeted carefully for homeownership but discovered their actual housing costs exceeded their financial capacity due to hidden expenses Lance should have disclosed before they committed to mortgage loans. Lance had been meeting loan volume targets while families faced foreclosure risks from mortgage payments they couldn't afford based on his incomplete cost disclosures. When mortgage regulators investigated his lending practices, they found evidence Lance had concealed mortgage costs affecting over 500 families while helping them obtain loans with payments that exceeded their ability to pay, resulting in foreclosures and financial hardship for borrowers who trusted his mortgage expertise. Our seventh story involves Metropolitan Bank, where personal banker Olivia had been managing customer relationships for 10 years. She consistently provided account services while helping customers with banking products and financial planning needs. Olivia seemed knowledgeable about banking services and genuinely committed to helping customers manage their finances effectively. Olivia's personal attention has helped me organize my finances and choose the right banking products, announced satisfied customer Pedro during a bank survey. Her financial guidance has improved my money management while saving me fees and charges. But customers started discovering they had been enrolled in banking products and services that Olivia claimed they had requested, but they didn't remember agreeing to purchase or activate. I'm being charged for overdraft protection and credit monitoring that I never signed up for, explained confused customer Quinn to the bank ombudsman. Olivia says I requested these services, but I specifically told her I didn't want any additional products on my account. When Quinn requested documentation of his service authorizations, Olivia provided papers that appeared to show his consent for products he was certain he had declined during their banking consultations. Investigation revealed Olivia had been fraudulently enrolling customers in fee-generating banking products while forging authorization documents that made unauthorized services appear legitimate under customer consent agreements. She'd been adding overdraft protection, credit monitoring, and investment services that generated monthly fees, creating false signatures and consent forms that suggested customers had requested products they actually rejected. The scheme particularly harmed elderly customers who trusted Olivia's advice but faced mounting fees from services they didn't want or understand but couldn't afford to maintain on their fixed incomes. Olivia had been meeting sales targets for banking products while customers faced financial strain from unauthorized services that consumed their banking resources without providing benefits they had never requested. When bank investigators examined her customer management, they found evidence Olivia had fraudulently enrolled over 900 customers in unauthorized banking products while generating fees exceeding $1 million from services that customers never consented to receive. Our eighth story takes us to Trust Bank, where investment advisor Rachel had been managing client portfolios for 14 years. She consistently helped clients build wealth while providing comprehensive financial planning and investment management services for retirement and long-term financial goals. Rachel seemed experienced and knowledgeable about investment strategies that balanced growth potential with appropriate risk management for client needs. Rachel's investment management has helped me build substantial wealth while protecting my principal, praised client Silas during an investment advisory testimonial. Her conservative approach and diversified strategy have provided excellent returns while minimizing risk to my retirement savings. But clients started questioning why their investment accounts showed fees and charges that Rachel had never mentioned when discussing her management services and fee structure. I'm being charged advisory fees, transaction costs, and management expenses that add up to more than my account gains, explained concerned client Tessa to the securities regulator. Rachel never disclosed these fees when she explained her investment management approach and cost structure. When Tessa requested detailed fee documentation, Rachel provided explanations that seemed designed to justify charges rather than provide clear disclosure of actual costs that were reducing client investment returns. Investigation revealed Rachel had been implementing hidden fee structures while providing false cost disclosures that concealed the true expense of her investment management services from clients who trusted her financial expertise. She'd been charging excessive management fees, transaction costs for trades that weren't necessary, and administrative expenses that consumed client returns without providing corresponding investment value or portfolio benefits. The scheme particularly harmed retirees who needed investment income for living expenses but discovered their returns were consumed by fees that left them with inadequate income for their retirement needs. Rachel had been maximizing her advisory income while clients faced retirement insecurity from hidden fees that reduced their investment returns below levels necessary for financial security. When securities authorities investigated her investment management, they found evidence Rachel had collected over $3 million in hidden fees while managing portfolios that underperformed due to excessive costs affecting nearly 600 clients who trusted her investment expertise. Our ninth story involves Fidelity Bank, where loan processor Uma had been handling mortgage and personal loan applications for 8 years. She consistently processed loan paperwork while ensuring proper documentation and approval procedures for borrowers seeking credit for various financial needs. Uma seemed professional and detail-oriented in her loan processing responsibilities and customer service approach. Uma's loan processing expertise ensured our mortgage application went smoothly without delays, praised borrower Victor during a customer feedback survey. Her attention to detail and knowledge of requirements helped us get approved quickly for our home purchase. But borrowers started discovering their loan applications contained false information that Uma claimed was necessary to improve their approval chances and secure better interest rates. My loan application shows income and employment information that isn't accurate, explained concerned borrower Wendy to the bank compliance department. Uma said adjusting these details would help me qualify for better terms, but I'm worried about providing false information. When Wendy questioned Uma about the application discrepancies, Uma claimed income adjustments were standard practices that helped borrowers present their financial situation in the most favorable light for underwriting approval. Loan applications require strategic presentation of financial information, Uma explained dismissively. These adjustments help borrowers qualify for loans they can actually afford, but might not get approved for without proper documentation strategy. But investigation revealed Uma had been systematically falsifying loan applications while encouraging borrowers to provide false financial information that would improve approval rates but create liability for borrowers who might not actually qualify for loans they received. She'd been inflating income figures, creating false employment documentation, and altering credit information to help borrowers get approved for loans they couldn't afford based on their actual financial situation. The scheme particularly harmed borrowers who trusted Uma's expertise but faced legal liability for loan fraud and payment difficulties from loans they received based on false information that misrepresented their ability to repay. Uma had been meeting loan approval targets while borrowers faced foreclosure and legal problems from loans they obtained through fraudulent applications that misrepresented their financial capacity. When federal investigators examined her loan processing, they found evidence Uma had falsified over 400 loan applications while helping borrowers obtain credit worth nearly $15 million based on false financial information that created liability for both borrowers and the banking institution. Our 10th story comes from Savings Bank, where branch operations manager Xavier had been overseeing daily banking activities for 9 years. He consistently managed teller operations while ensuring efficient customer service and proper handling of banking transactions and account maintenance procedures. Xavier seemed experienced and professional in banking operations management and staff supervision responsibilities. Xavier's branch management ensures excellent customer service while maintaining efficient operations, announced District Manager Yolanda during a regional meeting. His operational expertise keeps our branch running smoothly while meeting customer needs and corporate performance objectives. But bank auditors started identifying cash handling discrepancies and transaction irregularities that suggested Xavier's operational oversight wasn't preventing theft and fraud in daily banking activities. This branch has consistent cash shortages and transaction errors that indicate internal control problems, explained bank auditor Zara during a compliance inspection. Xavier's supervision isn't detecting cash handling violations and customer account manipulation that affects banking integrity. When Zara questioned Xavier about the operational problems, he claimed cash discrepancies were due to teller errors and system glitches that were common in high-volume banking operations. Branch operations involve complex transactions that can result in minor discrepancies, Xavier explained confidently. Our controls identify and correct these issues through established reconciliation procedures that maintain account accuracy. But investigation revealed Xavier had been orchestrating systematic theft while manipulating internal controls that should have detected cash handling violations and account manipulation affecting customer funds and bank assets. He'd been coordinating with tellers to steal cash deposits, manipulating transaction records to hide missing funds, and creating false reconciliation reports that concealed systematic theft from bank oversight and customer detection. The scheme particularly harmed customers whose deposits were stolen but who trusted the bank's internal controls to protect their money and ensure accurate account balances. Xavier had been enriching himself and accomplices while customers faced missing deposits and the bank suffered losses from systematic theft that violated fiduciary responsibilities to protect customer funds. When bank investigators examined his operational management, they found evidence Xavier had orchestrated theft exceeding $5 million while supervising operations that violated internal controls designed to protect customer assets and banking integrity. Our 11th story involves Capital Bank, where wealth management advisor Aaron had been serving high-net-worth clients for 13 years. He consistently helped wealthy families preserve and grow their assets while providing comprehensive estate planning and investment management services. Aaron seemed knowledgeable about sophisticated financial strategies and genuinely committed to protecting family wealth across generations. Aaron's wealth management has helped our family preserve assets while planning for estate transitions, praised client Bella during a wealth advisory testimonial. His expertise in tax strategies and investment planning has protected our wealth while minimizing tax burdens for our family legacy. But wealthy clients started discovering their investment portfolios contained assets and strategies that Aaron had never discussed or explained during their wealth planning consultations. My portfolio includes investments in private equity and hedge funds that I never authorized, explained concerned client Cameron to the Securities Commission. Aaron says these investments are part of my diversification strategy, but I specifically told him I wanted conservative investments only. When Cameron requested detailed portfolio documentation, Aaron provided explanations that seemed designed to justify unauthorized investments rather than provide clear disclosure of actual portfolio composition and investment risks. Investigation revealed Aaron had been implementing unauthorized investment strategies while using client funds for high-risk investments that generated commissions for him, but created losses and liquidity problems for wealthy families who expected conservative wealth preservation. He'd been investing client money in illiquid private investments, charging excessive fees for portfolio management, and implementing tax strategies that created audit risks and penalties for clients who trusted his wealth management expertise. The scheme particularly harmed wealthy families who needed liquidity for estate planning and family expenses but discovered their assets were tied up in illiquid investments that couldn't be accessed when needed for financial obligations. Aaron had been maximizing his advisory fees while clients faced wealth preservation problems from unauthorized investment strategies that violated their conservative wealth management objectives. When wealth management authorities investigated his advisory practices, they found evidence Aaron had unauthorized invested over $50 million of client funds while implementing strategies that created tax liabilities and liquidity problems affecting nearly 200 wealthy families who trusted his wealth preservation expertise. Our 12th story takes us to Heritage Bank, where commercial loan officer Bianca had been serving business customers for 11 years. She consistently helped companies secure financing while providing guidance on business credit and expansion funding needs. Bianca seemed knowledgeable about commercial lending and genuinely committed to helping businesses grow and succeed through appropriate financing solutions. Bianca's commercial lending expertise helped our company expand operations while managing debt effectively, announced business owner Diego during a Chamber of Commerce meeting. Her guidance on financing options helped us grow our business while maintaining healthy cash flow for operations. But business borrowers started discovering their commercial loans contained terms and restrictions that Bianca had never mentioned during the application and approval process. Our loan has personal guarantees and collateral requirements that Bianca never explained, revealed frustrated business owner Eva to her attorney. She told us this was unsecured business credit, but now our personal assets are at risk if the business struggles. When Eva questioned Bianca about the undisclosed loan terms, Bianca claimed all provisions were included in loan documents and were standard requirements for commercial financing in their industry sector. Commercial loans require comprehensive documentation that protects both borrowers and lenders, Bianca explained defensively. All terms were properly disclosed according to commercial lending regulations and industry standards. But investigation revealed Bianca had been deliberately concealing loan terms while encouraging businesses to accept financing with personal guarantees and collateral requirements that created liability for business owners who thought they were getting unsecured commercial credit. She'd been hiding cross-default provisions, personal liability clauses, and collateral requirements that could result in personal asset seizure if businesses experienced financial difficulties or couldn't meet loan obligations. The scheme particularly harmed small business owners who trusted Bianca's expertise but discovered their personal assets were at risk from commercial loans they thought would only affect their business operations. Bianca had been meeting commercial lending targets while business owners faced personal financial ruin from loan obligations that extended beyond their business assets to threaten their personal wealth and family security. When commercial lending regulators investigated her loan practices, they found evidence Bianca had concealed loan terms affecting over 300 businesses while helping them obtain financing with personal liability exceeding $20 million that business owners never understood they were accepting. Our 13th story involves Treasury Bank, where customer service manager Finn had been overseeing account services for 7 years. He consistently managed customer complaints while ensuring resolution of banking problems and account service issues for customers experiencing difficulties with their banking relationships. Finn seemed professional and customer-focused in his service management approach and problem resolution methodology. Finn's customer service expertise resolved my banking problems quickly and fairly, praised customer Gina during a service satisfaction survey. His knowledge and problem-solving skills helped me get my account issues corrected when other bank staff couldn't help. But customers started discovering their service complaints were being resolved in ways that seemed to benefit the bank rather than address actual customer problems and legitimate banking concerns. Finn resolved my complaint by adding fees to my account instead of removing the unauthorized charges I complained about, explained frustrated customer Heath to the banking ombudsman. He said this was the best solution available, but now I owe more money than before I filed the complaint. When Heath questioned Finn about the complaint resolution approach, Finn claimed all solutions were designed to balance customer needs with bank policies and regulatory requirements that limited available resolution options. Customer service requires finding solutions that work within banking regulations and operational constraints, Finn explained dismissively. Sometimes customers need to accept compromises that address their concerns while maintaining account compliance. But investigation revealed Finn had been manipulating complaint resolution while implementing solutions that generated additional fees and charges rather than correcting legitimate customer problems that violated banking regulations and account agreements. He'd been adding fees instead of removing unauthorized charges, modifying account terms to justify previous violations, and creating false resolution documentation that made bank violations appear as customer service solutions. The scheme particularly harmed customers who filed legitimate complaints expecting fair resolution, but discovered they faced additional charges and account problems from complaint handling that made their banking situations worse rather than better. Finn had been protecting bank profits while customers faced increased costs from complaint resolution that violated their rights and worsened their banking problems rather than providing fair solutions. When banking regulators investigated his complaint management, they found evidence Finn had manipulated over 800 customer complaints while generating additional fees exceeding $600,000 from resolution processes that harmed customers rather than correcting legitimate banking violations. Our 14th story comes from Alliance Bank, where safe deposit box manager Iris had been overseeing vault services for 12 years. She consistently managed safe deposit facilities while ensuring secure storage and proper access procedures for customers who trusted the bank with their valuable possessions and important documents. Iris seemed professional and security conscious in her vault management responsibilities and customer service approach. Iris's vault management provides excellent security for our valuable items, praised customer Jake during a safety deposit testimonial. Her attention to security procedures gives us confidence that our important documents and valuables are properly protected. But safe deposit customers started discovering their boxes had been accessed without their knowledge, with valuable items missing or replaced with less valuable substitutes that Iris claimed were the original contents. My gold coins are missing from my safe deposit box, and Iris says I must have removed them, explained shocked customer Lila to the bank security department. But I haven't been to my box in over a year, and now my valuable collection is gone. When Lila demanded access logs for her safe deposit box, Iris provided records that seemed to show legitimate access patterns but didn't match Lila's actual visits to the vault facility. Investigation revealed Iris had been systematically accessing customer safe deposit boxes while stealing valuable contents and replacing them with worthless substitutes or empty boxes that concealed her theft from customer detection. She'd been using master keys to access boxes without customer knowledge, stealing jewelry, coins, and documents that had significant value, and creating false access records that suggested customers had removed their own valuables. The scheme particularly harmed elderly customers who stored family heirlooms and valuable collections but discovered their treasured possessions had been stolen when they needed to access items for estate planning or family emergencies. Iris had been enriching herself while customers faced devastating losses from theft of irreplaceable family valuables and important documents they had trusted the bank to protect. When bank investigators examined her vault management, they found evidence Iris had stolen valuables worth over $4 million from nearly 300 safe deposit boxes while violating the fundamental trust that customers placed in bank security for their most precious possessions. Our 15th story involves Premier Bank, where auto loan specialist Mia had been helping customers finance vehicle purchases for 10 years. She consistently helped borrowers secure favorable auto financing while guiding them through the loan application and approval process for new and used vehicle purchases. Mia seemed knowledgeable about automotive financing and genuinely committed to helping customers get affordable transportation through appropriate loan terms. Mia's auto loan expertise helped me get financing for my car when other lenders turned me down, announced grateful customer Oscar during a customer testimonial. Her knowledge of loan programs helped me get approved with payments I can afford for reliable transportation. But auto loan borrowers started discovering their vehicle financing contained hidden costs and insurance requirements that Mia had never mentioned during the loan application and approval process. My auto loan payment is $200 higher than Mia quoted because of insurance and warranty costs, explained shocked borrower Penny to the Consumer Protection Agency. She never mentioned gap insurance or extended warranty requirements that make my car payment unaffordable for my budget. When Penny questioned Mia about the unexpected loan costs, Mia claimed all charges were disclosed in loan documents and were standard requirements for auto financing with their lending programs. Auto loans include various insurance and protection products that are disclosed in financing agreements, Mia explained defensively. These costs are necessary to protect both borrowers and lenders in case of vehicle damage or mechanical problems. But investigation revealed Mia had been systematically adding unauthorized insurance products while concealing the true cost of auto financing from borrowers who trusted her loan calculations and payment estimates. She'd been adding gap insurance, extended warranties, and credit protection that generated commission income for her but increased monthly payments beyond what borrowers could afford based on their budget calculations. The scheme particularly harmed young borrowers who needed reliable transportation for work but discovered their auto loan payments consumed more of their income than they could afford due to hidden costs that threatened their financial stability. Mia had been maximizing her commission income while borrowers faced financial strain from auto loans that cost significantly more than they had budgeted for vehicle financing. When auto lending regulators investigated her financing practices, they found evidence Mia had added unauthorized products to over 700 auto loans while generating hidden costs exceeding $2 million that made vehicle financing unaffordable for borrowers who trusted her payment calculations. Our 16th story takes us to Unity Bank, where Small Business Loan Officer Reed had been serving entrepreneurs for 8 years. He consistently helped small businesses secure financing while providing guidance on business credit and growth funding needs for companies seeking expansion capital and operational loans. Reed seemed experienced and knowledgeable about small business lending and genuinely committed to helping entrepreneurs succeed through appropriate financing solutions. Reed's business lending expertise helped our startup get the funding we needed to launch successfully, praised business owner Sophie during an entrepreneurship conference. His guidance on loan programs helped us secure financing while managing debt effectively for our new business operations. But small business borrowers started discovering their loans contained terms and restrictions that Reed had never explained during the application process, limiting their business operations in ways they never anticipated. Our loan prohibits us from making business decisions without bank approval, explained frustrated business owner Troy to his business attorney. Reed never mentioned that our financing agreement would restrict our operational autonomy and business decision-making authority. When Troy questioned Reed about the undisclosed loan restrictions, Reed claimed all provisions were standard requirements for small business lending that protected both borrowers and lenders from business risks. Small business loans require operational oversight that ensures borrowers can meet their debt obligations, Reed explained dismissively. These provisions protect business owners from making decisions that could jeopardize their ability to repay their loans. But investigation revealed Reed had been deliberately concealing loan covenants while encouraging small businesses to accept financing with operational restrictions that would limit their business flexibility and growth potential in ways that violated their entrepreneurial objectives. He'd been hiding cash flow requirements, inventory restrictions, and management approval clauses that gave the bank control over business operations while entrepreneurs thought they were getting capital to grow their companies independently. The scheme particularly harmed innovative startups that needed operational flexibility to adapt to market changes, but discovered their bank financing prevented them from making business decisions necessary for competitive success. Reed had been meeting small business lending targets while entrepreneurs faced business limitations from loan covenants that restricted their ability to operate and grow their companies effectively. When small business lending authorities investigated his loan practices, They found evidence Reed had concealed operational restrictions affecting over 200 small businesses while helping them obtain financing with covenants that limited business growth and operational freedom worth nearly $10 million in restricted business potential. Our 17th story involves Prosperity Bank, where credit analyst Vera had been evaluating customer creditworthiness for 9 years. She consistently assessed credit applications while ensuring appropriate risk evaluation and approval decisions for customers seeking various types of banking credit and loan products. Vera seemed professional and thorough in her credit analysis responsibilities and risk assessment methodology. Vera's credit analysis helped me understand my credit situation and improve my approval chances, praised customer Wade during a credit counseling testimonial. Her expertise helped me get approved for financing when my credit history was complicated by past financial difficulties. But credit applicants started discovering their credit reports contained inaccurate information that Vera claimed was necessary to improve their credit profiles and increase their approval chances for banking products. "My credit report shows payments and accounts that aren't mine," explained concerned applicant Zoe to the credit bureau. Vera said adding positive payment history would help my credit score, but now I have false information affecting my credit profile. When Zoe questioned Vera about the credit report discrepancies, Vera claimed credit enhancement services were legitimate practices that helped customers present their credit history in the most favorable light for lending approval. Credit analysis involves optimizing credit profiles to help customers qualify for financing they deserve, Vera explained confidently. These enhancements help borrowers overcome credit challenges that might prevent them from accessing necessary banking services. But investigation revealed Vera had been systematically manipulating credit reports while encouraging customers to accept false credit information that would improve their approval rates but create liability for identity fraud and false credit reporting. She'd been adding false payment histories, creating fictitious accounts with positive payment records, and altering credit scores through unauthorized credit report manipulation that violated federal credit reporting regulations. The scheme particularly harmed customers who trusted Vera's credit expertise but faced legal liability for credit fraud and potential prosecution for identity theft related to false credit information they never authorized. Vera had been meeting credit approval targets while customers faced criminal liability from credit manipulation that violated federal laws designed to protect credit reporting integrity and prevent identity fraud. When credit reporting authorities investigated her analysis practices, they found evidence Vera had manipulated over 900 credit reports while creating false credit information that exposed customers to criminal prosecution for credit fraud they never intended to commit. Our 18th story comes from Security Bank, where Vault Operations Supervisor Alex had been managing precious metals storage for 11 years. He consistently maintained secure storage while ensuring proper handling and inventory management for customers who trusted the bank with their gold, silver, and precious metal investments. Alex seemed professional and security-focused in his vault management responsibilities and precious metals expertise. Alex's vault management provides excellent security for our precious metals investments, announced customer Blake during an investment security testimonial. His expertise in precious metal storage gives us confidence that our gold and silver investments are properly protected and accurately tracked. But precious metals customers started discovering their stored metals had been replaced with lower-grade substitutes or missing altogether, with Alex claiming that metal quality testing had revealed impurities that required removal or replacement. "My gold bars have been replaced with gold-plated fakes," explained devastated customer Chelsea to the Securities Commission. Alex says the original metals didn't meet purity standards, but I had them independently tested before storage, and they were genuine. When Chelsea demanded independent verification of her stored metals, Alex provided documentation that seemed to show quality control procedures but didn't match the original assay reports from when she deposited her precious metals. Investigation revealed Alex had been systematically stealing precious metals while replacing them with fake substitutes and creating false quality control reports that justified the substitution of worthless metals for valuable customer investments. He'd been removing genuine gold and silver coins, replacing them with gold-plated counterfeits that appeared similar but had no precious metal value, and selling stolen metals to private buyers while maintaining false inventory records. The scheme particularly harmed retirees who had invested life savings in precious metals for inflation protection but discovered their valuable investments had been replaced with worthless fakes when they needed to liquidate assets for retirement income. Alex had been enriching himself while customers faced retirement insecurity from precious metals theft that destroyed their hedge against economic uncertainty and inflation protection strategies. When precious metals authorities investigated his vault operations, they found evidence Alex had stolen precious metals worth over $12 million while replacing customer investments with counterfeits that had no value for inflation protection or investment purposes. Our 19th story involves Heritage Bank, where wire transfer specialist Dana had been processing international and domestic money transfers for 7 years. She consistently handled wire transactions while ensuring proper documentation and compliance with money transfer regulations for customers sending funds domestically and internationally. Dana seemed knowledgeable about wire transfer procedures and genuinely committed to helping customers complete money transfers safely and efficiently. Dana's wire transfer expertise helped me send money to my family overseas quickly and securely, praised customer Eric during a money transfer testimonial. Her knowledge of international transfer requirements ensured my funds reached their destination without delays or complications. But wire transfer customers started discovering their money had been sent to wrong destinations or never reached the intended recipients, with Dana claiming processing errors and international banking complications beyond her control. My wire transfer to my son's college tuition never arrived, but Dana says the money was sent correctly, explained panicked customer Faye to the bank fraud department. The semester started and tuition is due, but the university never received the payment I sent through Dana's wire transfer service. When Faye demanded tracking information for her wire transfer, Dana provided documentation that seemed to show proper processing but didn't match the receiving bank's records of actual fund transfers. Investigation revealed Dana had been systematically diverting wire transfers while creating false processing records that concealed her theft of customer funds intended for legitimate recipients. She'd been redirecting wire transfers to accounts she controlled, creating fake confirmation numbers that suggested successful delivery, and manipulating tracking systems to hide missing funds that customers expected to reach their intended destinations. The scheme particularly harmed families sending tuition payments and emergency funds to relatives, but discovered their urgent money transfers had been stolen when recipients faced financial crises that required immediate assistance. Dana had been stealing customer funds while families faced educational and emergency situations without the financial support they had sent through trusted banking wire transfer services. When federal investigators examined her wire transfer operations, they found evidence Dana had stolen over $6 million through diverted wire transfers while creating false documentation that concealed systematic theft affecting nearly 800 customers who trusted bank wire transfer security. Our 20th story takes us to Capital Bank, where foreign exchange specialist Glenn had been managing currency transactions for 10 years. He consistently helped customers exchange currencies while providing guidance on international currency needs for travel, business, and investment purposes. Glenn seemed experienced and knowledgeable about foreign exchange markets and genuinely committed to helping customers get favorable exchange rates for their currency needs. Glenn's foreign exchange expertise helped me get excellent rates for my European business trip, announced customer Holly during a currency exchange testimonial. His knowledge of currency markets helped me save money while ensuring I had the foreign currency I needed for international travel. But foreign exchange customers started discovering they received less foreign currency than Glenn's quoted exchange rates should have provided, with Glenn claiming market fluctuations and processing fees that consumed their expected currency amounts. I received 800 euros instead of the 1,000 euros Glenn calculated, explained confused customer Ivan to the bank manager. He says currency markets changed, but other banks are offering better rates than what I actually received. When Ivan questioned Glenn about the exchange rate discrepancies, Glenn claimed foreign exchange involved market volatility and processing costs that could affect final currency amounts customers received. Currency exchange requires real-time market adjustments and processing fees that can affect final amounts, Glenn explained dismissively. International currency markets fluctuate constantly, which can impact the final currency customers receive. But investigation revealed Glenn had been systematically providing inferior exchange rates while pocketing the difference between market rates and the rates he provided to customers who trusted his foreign exchange expertise. He'd been quoting favorable rates to attract customers, then providing less favorable actual exchanges while keeping the currency difference as personal profit from transactions that should have given customers full market value. The scheme particularly harmed international travelers and businesses that needed specific currency amounts for overseas expenses but received insufficient foreign currency that created financial problems during international travel and business operations. Glenn had been enriching himself while customers faced currency shortfalls that affected their international activities and travel experiences. When currency exchange authorities investigated his foreign exchange operations, they found evidence Glenn had stolen over $2 million through inferior exchange rates while affecting currency transactions for nearly 1,200 customers who trusted his foreign exchange expertise. Our 21st story involves First National Bank, where business banking specialist Jasper had been serving commercial customers for 8 years. He consistently helped businesses manage their banking relationships while providing guidance on commercial banking products and cash management services for companies of various sizes. Jasper seemed professional and knowledgeable about business banking and genuinely committed to helping companies optimize their banking relationships and financial operations. Jasper's business banking expertise helped our company streamline cash management while reducing banking costs, praised business owner Kendra during a commercial banking seminar. His knowledge of business banking products helped us improve our financial operations while saving money on banking fees. But business customers started discovering their commercial accounts contained unauthorized services and fees that Jasper claimed were necessary for optimal business banking and cash management efficiency. Our business account has cash management fees and wire transfer charges we never authorized, explained frustrated business owner Lewis to the business banking manager. Jasper said these services would improve our operations, but we specifically declined additional services to keep our banking costs low. When Lewis questioned Jasper about the unauthorized business banking services, Jasper claimed all services were recommended improvements that businesses typically accepted to optimize their commercial banking relationships and operational efficiency. Business banking requires comprehensive services that support commercial operations, Jasper explained confidently. These services provide value that justifies their costs through improved efficiency and cash management capabilities. But investigation revealed Jasper had been systematically adding unauthorized business banking services while generating commission income from products that businesses had specifically declined or never requested for their commercial banking needs. He'd been adding cash management services, wire transfer packages, and merchant services that generated monthly fees while businesses expected basic commercial banking without additional costs for services they didn't need. The scheme particularly harmed small businesses that operated on tight margins but faced unexpected banking costs that consumed their operating capital and reduced their profitability from unauthorized services that provided no operational benefits. Jasper had been maximizing his sales commissions while businesses faced financial strain from unauthorized banking costs that affected their cash flow and operational efficiency. When business banking regulators investigated his commercial banking practices, they found evidence Jasper had added unauthorized services to over 400 business accounts while generating fees exceeding $3 million from services that businesses never consented to receive. Our 22nd story comes from Trust Bank, where estate planning advisor Monica had been helping customers with wealth transfer planning for 12 years. She consistently provided estate planning guidance while helping families protect their assets and plan for generational wealth transfer through appropriate estate planning strategies and trust services. Monica seemed knowledgeable about estate law and genuinely committed to helping families preserve wealth and protect their legacy for future generations. Monica's estate planning expertise helped our family protect our assets while minimizing estate taxes, praised customer Nolan during an estate planning testimonial. Her knowledge of trust strategies helped us create a plan that preserves our wealth for our children and grandchildren. But estate planning clients started discovering their trust arrangements and estate plans contained provisions that Monica had never explained, giving the bank control over family assets in ways they never intended or authorized. Our family trust gives the bank trustee powers we never agreed to, explained concerned client Ophelia to her estate attorney. Monica said the trust would protect our assets, But now the bank can make decisions about our family wealth without our input or consent. When Ophelia questioned Monica about the unexpected trust provisions, Monica claimed trust documents required complex legal language that protected family assets while ensuring proper administration according to estate planning best practices. Estate planning involves sophisticated legal structures that require professional administration, Monica explained defensively. These provisions ensure proper trust management while protecting family assets from various legal and financial risks. But investigation revealed Monica had been systematically implementing trust arrangements that gave the bank excessive control over family assets while generating ongoing trustee fees that enriched the bank at the expense of family wealth preservation objectives. She'd been creating trust provisions that allowed bank intervention in family financial decisions, establishing fee structures that consumed trust assets through administrative costs, and implementing estate plans that served bank profits rather than family wealth protection goals. The scheme particularly harmed wealthy families who trusted Monica's estate planning expertise but discovered their family wealth was controlled by bank trustees who prioritized bank profits over family financial interests and legacy preservation. Monica had been generating trust fees while families faced loss of control over their wealth and estate planning objectives that should have protected family assets for future generations. When estate planning authorities investigated her trust arrangements, they found evidence Monica had created inappropriate trust provisions affecting over 150 families while generating trustee fees exceeding $8 million that consumed family wealth rather than preserving it for intended beneficiaries. Our 23rd story involves a regional bank where ATM operations manager Parker had been overseeing automated banking services for 9 years. He consistently maintained ATM networks while ensuring proper operation and security for customers who depended on automated banking for convenient access to their accounts and cash withdrawal services. Parker seemed professional and security conscious in his ATM management responsibilities and customer service approach. Parker's ATM management ensures reliable access to our accounts through convenient automated banking, announced customer Quinn during a banking convenience survey. His maintenance expertise keeps ATMs working properly while providing secure access to our funds when we need cash. But ATM customers started discovering unauthorized transactions and account access that Parker claimed were system errors or customer mistakes that occurred during automated banking operations. "My account shows ATM withdrawals I never made," explained confused customer Riley to the bank fraud department. Parker says the ATM system logged legitimate transactions, but I wasn't even in town when these withdrawals supposedly occurred. When Riley demanded ATM transaction records, Parker provided documentation that seemed to show legitimate customer activity, but didn't match Riley's actual ATM usage patterns and location history. Investigation revealed Parker had been systematically accessing customer accounts through ATM systems while creating false transaction records that made unauthorized withdrawals appear as legitimate customer activity. He'd been using administrative access to withdraw cash from customer accounts, manipulating ATM logs to show fake customer transactions, and stealing funds while customers trusted ATM security to protect their account access and prevent unauthorized withdrawals. The scheme particularly harmed customers who relied on ATM convenience for banking access, but discovered their accounts had been compromised through the very systems they trusted to provide secure automated banking services. Parker had been stealing customer funds while maintaining ATM operations that violated the fundamental security customers expected from automated banking systems. When bank investigators examined his ATM operations, they found evidence Parker had stolen over $3 million through unauthorized ATM access, while affecting nearly 2,000 customers who trusted ATM security for convenient account access. Our 24th story takes us to Community Bank, where retirement planning advisor Sage had been helping customers prepare for retirement for 11 years. She consistently provided retirement guidance while helping families build retirement savings and plan for financial security during their golden years through appropriate investment and saving strategies. Sage seemed knowledgeable about retirement planning and genuinely committed to helping customers achieve their retirement goals and financial independence. Sage's retirement planning expertise helped me build a solid retirement fund, praised customer Tyler during a retirement planning seminar. Her guidance on investment strategies helped me save effectively while preparing for a comfortable retirement with financial security. But retirement planning clients started discovering their retirement accounts contained investments and fees that Sage had never discussed during their retirement planning consultations and investment strategy meetings. My retirement account is invested in high-risk funds when I specifically requested conservative investments, explained concerned client Uma to the Securities Commission. Sage said my portfolio was designed for capital preservation, but I'm losing money instead of building retirement security. When Uma questioned Sage about the investment discrepancies, Sage claimed retirement planning required diversified strategies that balanced growth potential with risk management to achieve long-term retirement objectives. Retirement planning involves sophisticated investment approaches that optimize returns while managing appropriate risk levels, Sage explained dismissively. These investments provide growth potential that conservative strategies alone cannot achieve for retirement security. But investigation revealed Sage had been implementing unauthorized investment strategies while using client retirement funds for high-risk investments that generated commission income for her, but created losses for retirees who expected conservative wealth preservation for their golden years. She'd been investing retirement money in volatile mutual funds, charging excessive management fees that consumed retirement returns, and implementing tax strategies that created liability for clients who trusted her retirement planning expertise. The scheme particularly harmed retirees who needed stable income for living expenses but discovered their retirement accounts had been depleted by high-risk investments and excessive fees that threatened their financial security during retirement. Sage had been maximizing her advisory income while clients faced retirement insecurity from investment strategies that violated their conservative retirement planning objectives and financial preservation goals. When retirement planning authorities investigated her advisory practices, they found evidence Sage had inappropriately invested over $30 million of client retirement funds while generating commission income exceeding $2 million from strategies that threatened retirement security for nearly 500 clients who trusted her retirement planning expertise. Our 25th story involves Metro Bank, where cash management specialist Victor had been serving large corporate customers for 10 years. He consistently helped corporations manage their cash flow while providing guidance on corporate banking products and treasury management services for companies with complex financial operations. Victor seemed experienced and knowledgeable about corporate finance and genuinely committed to helping businesses optimize their cash management and banking relationships. Victor's cash management expertise helped our corporation improve liquidity while reducing banking costs, announced corporate treasurer Wendy during a treasury management conference. His knowledge of corporate banking helped us optimize our cash flow while maintaining efficient banking operations. But corporate customers started discovering their cash management agreements contained fees and restrictions that Victor had never mentioned during their corporate banking consultations and service implementations. Our cash management service has concentration banking fees that consume our interest earnings, explained frustrated corporate controller Xander to the corporate banking director. Victor never mentioned these fees when he recommended consolidating our accounts for better cash management efficiency. When Xander questioned Victor about the undisclosed cash management fees, Victor claimed corporate banking required comprehensive fee structures that supported sophisticated cash management services and operational efficiency for large corporate customers. Corporate cash management involves complex services that require appropriate fee structures, Victor explained confidently. These fees support the infrastructure necessary to provide sophisticated treasury management services for corporate banking relationships. But investigation revealed Victor had been systematically concealing cash management fees while implementing corporate banking services that generated excessive charges, which consumed corporate cash flow and reduced the efficiency benefits that companies expected from treasury management services. He'd been hiding concentration banking fees, wire transfer charges, and account analysis fees that made cash management services more expensive than the benefits they provided to corporate customers. The scheme particularly harmed corporations that implemented cash management services to improve efficiency, but discovered the hidden fees consumed their cash flow improvements and made corporate banking more expensive than traditional banking arrangements. Victor had been meeting corporate banking revenue targets while companies faced unexpected costs from cash management services that reduced rather than improved their banking efficiency and cash flow optimization. When corporate banking regulators investigated his cash management practices, They found evidence Victor had concealed fees affecting over 200 corporations while generating hidden charges exceeding $5 million that reduced corporate cash flow and banking efficiency. Our 26th story comes from Alliance Bank, where credit card fraud investigator Yasmin had been protecting customers from fraudulent card activity for 8 years. She consistently investigated suspicious transactions while helping customers resolve unauthorized charges and protect their accounts from credit card fraud and identity theft. Yasmin seemed professional and security-focused in her fraud investigation responsibilities and customer protection approach. Yasmin's fraud investigation expertise helped me resolve unauthorized charges quickly, praised customer Zane during a fraud protection testimonial. Her knowledge of fraud patterns helped protect my account while ensuring I wasn't liable for charges I didn't make. But credit card customers started discovering their fraud claims were being denied or minimized in ways that seemed to protect the bank's interest rather than provide appropriate customer protection from fraudulent activity and unauthorized charges. Yasmin denied my fraud claim even though I was out of the country when the charges occurred, explained frustrated customer Aria to the Consumer Protection Agency. She says the charges appear legitimate, but I have passport stamps proving I couldn't have made those purchases. When Aria appealed her fraud claim denial, Yasmin provided responses that seemed designed to avoid liability rather than provide fair investigation of obvious fraudulent activity that should have been covered under credit card protection policies. Investigation revealed Yasmin had been systematically denying legitimate fraud claims while protecting bank profits from credit card losses that should have been absorbed by the bank rather than charged to customers who were victims of identity theft and unauthorized card usage. She'd been creating false fraud investigation reports, ignoring evidence of obvious unauthorized activity, and pressuring customers to accept liability for charges they never made to reduce bank losses from credit card fraud. The scheme particularly harmed customers who were victims of identity theft but were forced to pay for fraudulent charges when bank fraud protection should have covered unauthorized transactions and protected them from financial liability. Yasmin had been protecting bank profits while customers faced financial hardship from fraudulent charges they never made but were forced to pay due to improper fraud investigation that violated credit card protection regulations. When credit card fraud authorities investigated her fraud investigation practices, they found evidence Yasmin had inappropriately denied over 1,200 fraud claims while forcing customers to pay nearly $4 million for fraudulent charges that should have been covered by bank fraud protection policies. Our 27th story involves First Trust Bank, where Asset Management Director Blake had been overseeing investment portfolios for 13 years. He consistently managed client assets while providing comprehensive investment management and financial planning services for high-net-worth individuals and institutional clients with substantial investment portfolios. Blake seemed experienced and knowledgeable about asset management and genuinely committed to helping clients achieve their investment objectives and financial goals through sophisticated portfolio strategies. Blake's asset management expertise has helped our foundation preserve assets while generating steady returns, praised institutional client Celia during an investment management testimonial. His knowledge of investment strategies has protected our endowment while providing income for our charitable mission and operational needs. But asset management clients started discovering their investment portfolios contained unauthorized trades and investment strategies that Blake had never discussed or explained during their investment planning consultations and portfolio reviews. "My portfolio contains private equity investments I never authorized," explained concerned client Derek to the Securities Commission. "Blake says these investments are part of my diversification strategy, but I specifically requested liquid investments only for my retirement planning." When Derek questioned Blake about the unauthorized portfolio changes, Blake claimed asset management required dynamic strategies that adapted to market conditions while optimizing returns and risk management for long-term investment success. Asset management involves sophisticated investment approaches that require professional discretion, Blake explained dismissively. These strategies optimize portfolio performance while managing appropriate risk levels for long-term investment objectives. But investigation revealed Blake had been implementing unauthorized trading strategies while using client funds for high-risk investments that generated trading commissions and management fees for him, but created losses and liquidity problems for clients who expected conservative asset management. He'd been investing client money in illiquid private investments, implementing high-frequency trading strategies that generated transaction costs, and charging excessive management fees that consumed investment returns clients needed for income and capital preservation. The scheme particularly harmed retirees and institutions that needed liquidity and income from their investments but discovered their assets were tied up in illiquid investments that couldn't be accessed when needed for operational expenses and income requirements. Blake had been maximizing his management fees while clients faced liquidity problems from unauthorized investment strategies that violated their conservative asset management objectives and income needs. When asset management authorities investigated his investment practices, they found evidence Blake had unauthorized traded over $100 million of client assets while generating fees exceeding $6 million from strategies that created liquidity problems and investment losses for nearly 300 clients who trusted his asset management expertise. Our 28th story takes us to Security Bank, where trade finance specialist Eva had been helping businesses with international commerce for 9 years. She consistently facilitated international trade while providing guidance on letters of credit, trade financing, and international payment systems for companies engaged in global business operations. Eva seemed knowledgeable about trade finance and genuinely committed to helping businesses succeed in international markets through appropriate trade financing and payment solutions. Eva's trade finance expertise helped our company expand internationally while managing payment risks, announced importer Felix during an international trade seminar. Her knowledge of trade financing helped us secure favorable terms while protecting our company from international payment risks and currency fluctuations. But trade finance customers started discovering their international transactions contained hidden fees and unfavorable exchange rates that Eva had never disclosed during their trade financing consultations and international payment arrangements. Our letter of credit has processing fees and currency charges that cost more than Eva quoted, explained frustrated exporter Grace to the trade finance manager. She never mentioned these additional costs when she calculated our international payment expenses and trade financing costs. When Grace questioned Eva about the undisclosed trade finance costs, Eva claimed international commerce required complex fee structures that supported sophisticated trade financing services and international payment processing capabilities. Trade finance involves intricate international processes that require comprehensive fee structures, Eva explained confidently. These costs support the infrastructure necessary to provide reliable international payment and trade financing services. But investigation revealed Eva had been systematically concealing trade finance fees while implementing international payment services that generated excessive charges, which consumed the profit margins that businesses expected from international trade and commerce opportunities. She'd been hiding currency conversion fees, letter of credit processing charges, and documentary fees that made international trade more expensive than the benefits businesses received from global market access and expansion opportunities. The scheme particularly harmed small exporters and importers who entered international markets to increase profits, but discovered hidden trade finance costs consumed their expected margins and made international business unprofitable rather than beneficial. Eva had been meeting trade finance revenue targets while businesses faced unexpected costs from international commerce that reduced rather than improved their profitability and global market success. When trade finance regulators investigated her international banking practices, they found evidence Eva had concealed fees affecting over 400 international transactions while generating hidden charges exceeding $3 million that reduced business profitability from international trade operations. Our 29th story involves Premier Bank, where private banking advisor Hugo had been serving ultra-high net worth clients for 14 years. He consistently provided exclusive banking services while helping extremely wealthy individuals and families manage their complex financial needs through sophisticated private banking and wealth management solutions. Hugo seemed experienced and discreet in his private banking responsibilities and client relationship management approach. Hugo's private banking expertise provides excellent service for our family's complex financial needs, praised ultra-wealthy client Iris during a private banking testimonial. His knowledge of sophisticated banking solutions helps us manage our wealth while maintaining the privacy and service level we require for our financial affairs. But private banking clients started discovering their exclusive banking arrangements contained fees and investment requirements that Hugo had never disclosed during their private banking consultations and wealth management planning sessions. Our private banking relationship has asset management fees that consume our account benefits, explained concerned client Jasper to the private banking director. Hugo never mentioned these costs when he explained the advantages of private banking over our previous wealth management arrangements. When Jasper questioned Hugo about the undisclosed private banking fees, Hugo claimed ultra-high net worth banking required comprehensive fee structures that supported sophisticated private banking services and exclusive wealth management capabilities for extremely wealthy clientele. Private banking involves premium services that require appropriate fee structures, Hugo explained dismissively. These fees support the specialized infrastructure necessary to provide exclusive banking and wealth management services for ultra-high net worth clients. But investigation revealed Hugo had been systematically concealing private banking fees while implementing exclusive banking services that generated excessive charges which consumed the service benefits that ultra-wealthy clients expected from premium private banking relationships and wealth management solutions. He'd been hiding asset management fees, private banking service charges, and exclusive account fees that made private banking more expensive than the benefits clients received from sophisticated wealth management and exclusive banking services. The scheme particularly harmed ultra-wealthy families who chose private banking for superior service but discovered hidden fees consumed their expected benefits and made exclusive banking arrangements less advantageous than traditional wealth management solutions. Hugo had been meeting private banking revenue targets while ultra-wealthy clients faced unexpected costs from exclusive banking services that reduced rather than enhanced their wealth management outcomes and banking experience. When private banking regulators investigated his exclusive banking practices, they found evidence Hugo had concealed fees affecting over 100 ultra-wealthy clients, while generating hidden charges exceeding $12 million that reduced the value and benefits of private banking relationships. Our 30th story comes from Capital Bank, where correspondent banking manager Luna had been facilitating relationships between financial institutions for 10 years. She consistently managed interbank relationships while providing guidance on correspondent banking services and institutional financial connections for banks and credit unions needing specialized banking capabilities. Luna seemed professional and knowledgeable about correspondent banking and genuinely committed to helping financial institutions optimize their interbank relationships and service capabilities. Luna's correspondent banking expertise helped our credit union access services we couldn't provide independently, announced Credit Union President Marcus during an institutional banking conference. Her knowledge of interbank relationships helped us expand our service offerings while maintaining operational efficiency for our member services. But correspondent banking clients started discovering their interbank agreements contained fees and service restrictions that Luna had never mentioned during their correspondent banking consultations and institutional relationship arrangements. Our correspondent banking agreement has transaction fees that make interbank services more expensive than expected, explained frustrated bank president Nina to the correspondent banking director. Luna never disclosed these costs when she recommended establishing correspondent relationships for our specialized banking needs. When Nina questioned Luna about the undisclosed correspondent banking fees, Luna claimed interbank relationships required complex fee structures that supported sophisticated correspondent banking services and institutional financial connections between different types of financial institutions. Correspondent banking involves intricate interinstitutional processes that require comprehensive fee structures, Luna explained confidently. These costs support the infrastructure necessary to provide reliable interbank services and institutional financial connections. But investigation revealed Luna had been systematically concealing correspondent banking fees while implementing interbank services that generated excessive charges which consumed the operational benefits that financial institutions expected from correspondent banking relationships and specialized service access. She'd been hiding transaction processing fees, interbank service charges, and institutional relationship fees that made correspondent banking more expensive than the benefits institutions received from expanded service capabilities and interbank operational efficiency. The scheme particularly harmed smaller banks and credit unions that established correspondent relationships to expand services but discovered hidden fees consumed their expected operational improvements and made interbank arrangements less beneficial than independent operations. Luna had been meeting correspondent banking revenue targets while financial institutions faced unexpected costs from interbank relationships that reduced rather than improved their operational efficiency and service expansion capabilities. when correspondent banking regulators investigated her interinstitutional banking practices. They found evidence Luna had concealed fees affecting over 300 interbank relationships while generating hidden charges exceeding $8 million that reduced the operational benefits of correspondent banking arrangements. Our 31st story involves Trust Bank, where Fiduciary Services Director Oscar had been managing trust administration for 12 years. He consistently administered trust accounts while providing guidance on trust management and fiduciary responsibilities for families and institutions that relied on professional trust administration for wealth preservation and beneficiary services. Oscar seemed experienced and trustworthy in his fiduciary responsibilities and trust administration approach. Oscar's trust administration expertise ensures our family trust is managed properly, praised trust beneficiary Penny during a fiduciary services testimonial. His knowledge of trust management protects our family wealth while ensuring beneficiaries receive appropriate distributions according to trust terms and objectives. But trust beneficiaries started discovering their trust distributions were being reduced by administrative fees and management costs that Oscar had never disclosed during trust administration consultations and beneficiary communications. Our trust distributions are lower than expected because of administrative fees that consume trust income, explained concerned beneficiary Quinn to the Trust Oversight Board. Oscar never mentioned these costs when he explained how trust administration would preserve and distribute our family wealth. When Quinn questioned Oscar about the undisclosed trust administration fees, Oscar claimed professional trust management required comprehensive fee structures that supported sophisticated fiduciary services and trust administration capabilities for complex family and institutional trusts. Trust administration involves professional fiduciary services that require appropriate fee structures, Oscar explained dismissively. These fees support the specialized expertise necessary to provide proper trust management and beneficiary services for complex trust arrangements. But investigation revealed Oscar had been systematically concealing trust administration fees while implementing fiduciary services that generated excessive charges, which consumed trust assets and reduced distributions that beneficiaries expected from family wealth preservation and trust income objectives. He'd been hiding trust management fees, fiduciary service charges, and administrative costs that made trust administration more expensive than the benefits beneficiaries receive from professional trust management and wealth preservation services. The scheme particularly harmed trust beneficiaries who depended on trust distributions for income, but discovered administrative fees consumed their expected distributions and reduced the family wealth that trusts were designed to preserve and distribute. Oscar had been meeting trust services revenue targets, while beneficiaries faced reduced distributions from trust administration costs that consumed family wealth rather than preserving it for intended beneficiary support. When fiduciary authorities investigated his trust administration practices, they found evidence Oscar had concealed fees affecting over 200 trust accounts while generating hidden charges exceeding $15 million that reduced trust assets and beneficiary distributions. Our 30-second story takes us to Regional Bank, where International Banking Director Rachel had been managing global banking services for 11 years. She consistently facilitated international banking while providing guidance on global financial services and cross-border banking solutions for customers with international financial needs and global business operations. Rachel seemed experienced and knowledgeable about international banking and genuinely committed to helping customers navigate complex global financial requirements and cross-border banking challenges. Rachel's international banking expertise helped our company manage global operations effectively, announced multinational business owner Samuel during an international finance conference. Her knowledge of cross-border banking helped us optimize our international financial operations while managing currency risks and regulatory compliance. But international banking customers started discovering their global banking arrangements contained hidden costs and regulatory complications that Rachel had never disclosed during international banking consultations and cross-border financial planning sessions. Our international banking has compliance fees and regulatory costs that make global operations more expensive than projected, explained frustrated international business owner Talia to the international banking manager. Rachel never mentioned these additional expenses when she calculated our international banking costs and cross-border operational efficiency. When Talia questioned Rachel about the undisclosed international banking costs, Rachel claimed global banking required complex regulatory compliance and fee structures that supported sophisticated international financial services and cross-border banking capabilities for customers with global operations. International banking involves intricate regulatory processes that require comprehensive compliance and fee structures, Rachel explained confidently. These costs support the infrastructure necessary to provide reliable cross-border banking and international financial services. But investigation revealed Rachel had been systematically concealing international banking fees while implementing global financial services that generated excessive charges which consumed the operational benefits that customers expected from international banking and cross-border financial efficiency. She'd been hiding currency conversion fees, international wire transfer charges, and regulatory compliance costs that made international banking more expensive than the benefits customers received from global financial operations and cross-border business efficiency. The scheme particularly harmed international businesses that established global banking to improve efficiency, but discovered hidden costs consumed their expected operational improvements and made international operations less profitable than domestic business activities. Rachel had been meeting international banking revenue targets while customers faced unexpected costs from global banking services that reduced rather than improved their international operational efficiency and cross-border business profitability. When international banking regulators investigated her global financial practices, they found evidence Rachel had concealed fees affecting over 500 international banking relationships while generating hidden charges exceeding $10 million that reduce the operational benefits of global banking and cross-border financial services. Our 33rd story brings us to the headquarters of Megabank Corporation, where Chief Executive Officer Sophia had been overseeing all banking operations for 16 years. She seemed like the perfect banking executive, managing everything from retail banking to investment services with apparent expertise and industry recognition for innovation and customer service excellence. Sophia has transformed Megabank into an industry leader in financial services while maintaining the highest standards for customer satisfaction, praised Banking Industry magazine editor Thomas during a Financial Leadership Awards ceremony. Her visionary leadership has delivered comprehensive banking solutions that serve customer needs while advancing the evolution of modern banking services. But a coordinated investigation by multiple federal agencies revealed that Sophia had been orchestrating comprehensive fraud schemes across every aspect of banking operations while maintaining an elaborate facade of industry leadership and customer service commitment. Examination of all bank divisions simultaneously uncovered the most extensive banking fraud operation in financial industry history. Sophia had been implementing fraudulent practices in retail banking, commercial lending, investment services, trust administration, and international banking, while stealing billions of dollars from customers, investors, and government programs across every aspect of financial services operations. The investigation revealed Sophia had orchestrated fraud schemes worth over $20 billion affecting millions of customers across all banking services while maintaining industry recognition for supposed financial innovation and customer service excellence. When federal authorities arrested Sophia during a Banking Industry Awards ceremony where she was receiving recognition for outstanding leadership in customer protection and financial innovation, shocked industry colleagues couldn't believe the executive they'd respected had been deliberately exploiting every customer she was supposed to serve while destroying trust in banking institutions that families and businesses depended on for essential financial services and economic security. Thank you for joining me tonight on Drowsy Tales Daily. And may these stories guide you into peaceful sleep with renewed awareness of the importance of banking accountability and protecting consumers from financial institutions that would exploit their trust during vulnerable financial situations. Sweet dreams. And I'll see you tomorrow night for another collection of fascinating Reddit stories designed to help you drift off to sleep.